As more homeowners in the U.S. struggle to keep up with mortgage payments and maintenance costs, new data shows the number of property foreclosures is steadily rising. According to property data from Adam, foreclosure filings rose for 6 months straight year over year. And as of August, the number of foreclosures, that was up 18% from the same time last year. Those numbers put the U.S. on track to surpass the roughly 322,000 total properties that went into foreclosure last year.
We live in the age of information. With the internet, almost everything is just a click away. But here's something funny. The government and the Federal Reserve keep telling us that the economy is strong and everything is fine. Yet the things people are actually searching for online tell a very different story. Recently, a viral thread showed that Google searches for the phrase, quote, help with mortgage, are at their highest level since 2009. Think about that. We haven't seen this much online interest in mortgage help since right after the big housing crash. This isn't data you can argue with. Google tracks what people search for. There's no agenda, no spin. The fact is, more people are searching for mortgage help today than in the last 16 years. That tells us a lot of people are struggling to pay for their homes right now. Now, Google Trends doesn't show the exact number of searches. It just shows whether the volume is high or low compared to the past. And of course, some economists try to brush it off. They say, well, we don't know the exact number of searches, so it doesn't mean much. But let's be honest, if searches are just as high today as they were during the 2008 and 2009 crisis, that's a huge red flag. Whether it's 5 million people or 8 million, it's still a lot of people looking for help. The last time we saw a smaller spike in these searches was in March of 2020, right when the pandemic began. And that wasn't a coincidence. People were panicked then, and people are panicked now. Some analysts try to spin this in a positive way. They suggest maybe financially stable people are just searching mortgage help just in case, like if they're worried about layoffs. But doesn't that still signal trouble? If even people with jobs and stable mortgages are nervous enough to search for help, that shows real fear about the economy. Others point out that more people use the internet today compared to 2009. That's true. But doesn't that make it even more concerning? If internet use is much higher today and searches are still at the same level as 2009, that means the real number of people searching could be even larger. And here's where it gets worse. The rise in these searches is happening at the exact same time mortgage delinquencies are climbing. By July of 2025, there were 30,000 more households seriously behind on their mortgage compared to a year earlier. Seriously delinquent means they're at least 90 days late. That's not a small number. That's 30,000 families struggling to hold onto their homes. And do you know which loans are most at risk? FHA loans. In fact, FHA loans made up 52% of all serious delinquencies in July. Let's step back. An FHA loan is a type of mortgage that's easier to qualify for. You can get one with a credit score as low as 580. You can also put as little as 3.5% down, and in some cases even borrow that down payment from other programs. Compared to conventional mortgages, FHA loans require less money up front and allow weaker credit. That flexibility helps people buy homes, but it also means a lot of borrowers are financially fragile. Many don't have the savings or income to weather tough times. And the data shows that because just 6 months after buying, many FHA borrowers are already falling behind on payments. This looks very similar to what we saw before the 2008 crash. Back then, too many risky loans were handed out, and people quickly defaulted. The numbers today are already worse than the years after that crisis. Now, some people might ask, if so many are struggling, why haven't we seen a giant wave of foreclosures yet? The answer is simple: government intervention. The government has been quietly propping up many FHA borrowers. They've given out forbearances, bought down mortgage rates, and even used taxpayer money to pay parts of these mortgages. In fact, this kind of help has been provided to around 2 million properties nationwide. But here's the problem: that support won't last forever. At some point, the government has to stop spending money to keep people in homes they can't afford. And when that happens, we could see a flood of foreclosures. The warning signs are already here. Foreclosure filings in August of 2025 were up 18.1% compared to August of 2024. Not only that, but filings have been steadily rising for the last 6 months. Now, I'm not saying we're back at 2008 levels yet, but the trend is pointing in the wrong direction. Prices in many areas are already falling, even without a foreclosure surge. Imagine what happens when all that government support disappears and delinquent loans start turning into foreclosures. One article I read tried to dismiss concerns by saying, for another 2008-style crash to happen, we'd need the perfect storm: layoffs, falling home prices, and lots of recent home purchases. Well, let's check the boxes. Layoffs? We have plenty of those. Falling home prices? Already happening in many areas. The only piece missing is a surge in recent purchases. And that's true. Home sales have been very weak for the last 2 or 3 years, some of the slowest in 3 decades. But here's where things get even scarier. Current homeowners aren't just sitting still. Many are refinancing to take advantage of slightly lower rates. At first glance, that doesn't sound bad. But dig deeper, and you'll see most of these are cash-out refinances. That means people aren't just lowering their rate. They're borrowing against their home equity to pull cash out. Why are they doing this? Likely to cover everyday living expenses, since inflation has made everything more expensive. According to ICE, more than half of refinances today are cash-out loans. Applications to refinance jumped 58% in just 1 week after rates dipped into the low 6% range. And here's another troubling sign. Demand for adjustable-rate mortgages, where payments can change with short-term interest rates, has risen to 13% of all refinances. That's the highest share since 2008. It feels like deja vu. The same warning signs we saw before the last housing crash are flashing again. Rising delinquencies, more foreclosures, cash-out refinances, risky adjustable-rate loans. All of it looks familiar. So, while officials and media keep telling us the economy is strong, the real data tells another story. People are scared, people are struggling, and many are desperately looking for ways to keep their homes. If history teaches us anything, it's that these are the early warning signs of bigger problems ahead. So, what do you think? Are these just small bumps in the road? Or are we heading towards something much bigger? Because from where I'm standing, the numbers don't lie. If you found this breakdown helpful, make sure to hit that subscribe button and check out my other videos for more updates on what's really happening in the housing market.
Real estate agent Scott Nicholas is busy these days. He's doing an occupancy check at this foreclosed Jacksonville house. The bank owns it and wants to get rid of it.
In some cases, of course, we run into tenants that are living on the property or who are completely unaware that it was in the foreclosure process. And of course, that conversation can be a little interesting. But for the most part, the properties are usually vacant.
House after house, street after street, 47% of homes here are underwater, and half of all sales are homes in distress. No one is immune, not even real estate agents.